What if I told you that taking money out of your own business could trigger capital gains tax, even if you didn't sell a single thing? This isn't some IRS loophole. It's something most business owners and even a lot of accountants overlook, and it's called your basis. I had a client who thought they were playing it safe until they found out a $35,000 distribution came with a $7,000 surprise tax bill. Why? Because their basis had quietly eroded. In this episode, we're diving into the most boring sounding concept that might just save you thousands. And I'll show you why basis matters, how it's different for partnerships versus S corporations, and how to avoid accidentally turning tax-free money into a capital gain nightmare. All right, so let's dig into it. The first thing I want to talk about is what is basis and why does basis even matter? So the easy, simple definition of basis is that basis represents an owner's investment in a business when it comes to tax purposes. So why does it matter? Basis helps determine how much an owner can withdraw tax-free and also what the allowable losses are from that business that can offset other income for the tax year. Now, the key rule to think about when we're talking about basis is that you can not take tax-free distributions beyond your basis. So if you take distributions over and above your basis, now they become taxable. Now, let me go through a client story. We had a client that thought they were taking tax-free distributions. They were taking money out. They had some loans outstanding. They're taking money out. And all of a sudden it comes up to tax time. And they have this surprise capital gain tax bill because they took more out of their company than they had in basis. And we're going to break down what basis is, how it calculates. It's a relatively easy calculation from, a general standpoint, but we're also going to talk about why it happens and how to avoid it. So there's different types of basis rules based on your entity type, and this might come into play when you're choosing an entity type to determine which one might make the sense based on your business operations. First we want to talk about is partnership outside basis. So this is if you're a partner. You have 50-50, 60-40, you have 10-10-10-10, whatever it is, this would be for partnerships. And the way you calculate basis for a partnership is whatever your initial investment is, plus any income that business operates, plus any additional contributions that you make to that partnership, minus any losses that partnership has, minus any distributions that partnership has, and then you also add in your share of liabilities to that calculation as well. And a basis is it's like a snowball. It just continues to go. So this is not something that ends on 12/31 each year and restarts. A basis calculation is something that goes on year after year after year, and it's a rolling basis calculation. So for a partnership, you have your initial investment plus any income from the business, minus any losses from the business, plus any contributions. If you're making more, putting more money into the partnership, that adds to your basis. When you take money out of the partnership, that decreases your basis. And if you have any liabilities that you're responsible for, that increases your basis. Now let's look at it from an S corporation, because we talk about S corporations all the time, but there is some limiting items here. So let's look at an S Corp basis. What we just talked about was for partnerships. S Corp, you have your initial investment plus any income that the business generates, plus any contributions, additional contributions that you put into the business, minus any losses from the business, and minus distributions. That's it. Initial investments plus income plus contributions minus losses minus distributions. Now you'll notice one thing I didn't talk about was liabilities. With an S corporation, outside loans and things like that do not increase your basis in an S corporation. And this is where we see so many people get caught and so many people get hit with this surprise capital gain tax bill. So let's talk about distributions. Distributions are considered tax-free. Now, distributions are tax-free, but they also don't reduce the profit in your business. So let's say you had $100,000 in profit and you take $100,000 in distributions. You're still paying taxes on $100,000. Now, those distributions were not taxable, but the profit is. So let's say you have $100,000 in profit and you take no distributions. You're taxed on $100,000. If you have $100,000 in profit and you take $40,000 in distributions, you're taxed on $100,000. If you have $100,000 in profit and you take $100,000 in distributions, you're taxed on $100,000. So the distributions generally are not taxed, you're taxed on the profit of your business. And so distributions are considered tax-free if you have basis. If you have enough basis to cover that distribution, there's no additional tax impact. But what happens if you take distributions in excess of your basis? Any amounts exceeding basis have tax consequences. They're going to get hit with capital gain tax. Now, in a partnership, excess basis is taxed as a capital gain, but with a partnership, if you have debt, that adds to your basis. That's a key thing. With an S corporation, distributions in excess of basis is taxed as a capital gain. Now, we're going to go through a case study to go through some planning opportunities, because this is not what I would say something we see with every single business owner. So a lot of business owners, this might not come into play, but we're going to talk about when it does come into play, why it comes into play, and some planning opportunities to avoid this unwanted additional capital gain tax on that. Now, real quick, if you're looking for tax strategies that you can actually implement, I built a software called TaxElm, where we don't just show you how to save on taxes, we help you turn those strategies into real dollars saved with clear, step-by-step guidance and full implementation modules within the software. If you're serious about paying the least amount of taxes legally possible this year, click the link below in the description and book a free discovery call with our team. All right, now back to basis. So let's go through a real life breakdown. Let's go through some facts. Let's say that your initial contribution, initial investment is $20,000. And let's say that your business had $10,000 in income and $5,000 in debt, and you took distributions of $35,000. So let's look at an S corporation. Your basis is going to be the initial amount, $20,000, plus income of $10,000. That's going to be your basis before you take any distributions. So $20,000 plus $10,000, that's $30,000. If you took distributions, like I mentioned, of $35,000, that's going to exceed your basis by $5,000, and that $5,000 in excess of your basis is going to be taxed as a capital gain. But now let's look at a partnership. The partnership basis is going to be a little bit different. It's going to be that initial stock amount, $20,000, plus the profit, the income of $10,000, plus the debt of $5,000. So your basis in a partnership is going to be $35,000. In an S corporation, it was only $30,000. Why? Because the debt doesn't add to your basis in an S corporation, but it does a partnership. So now let's say you take distributions of $35,000, that's what your total basis is, so there's no capital gain there. If you would have happened to take distributions of $40,000, then you would have exceeded your basis in that partnership. And again, same thing with an S corporation, $5,000 would be taxed as a capital gain. So let's talk about why this happens and how to avoid it. The main reason that this happens, especially for S corporation, is liabilities. You have credit cards, you have loans, you have various different liabilities in an S corporation, and these liabilities do not increase basis. So let's say you go out, you buy a piece of equipment, you buy something, and you get a loan for $500,000. You owe this money, but now you got $500,000 into your bank account because it was a loan that you received. If you take that $5,000 and just move it to your personal account, now first off, that probably wouldn't be allowed per se, that transaction, but let's just say that happens. You get a loan for $500,000 in your S corporation, and you move that $500,000 into your personal bank account as an owner's draw distribution. Well, that loan did not increase your basis by $500,000. Loans don't do that in an S corporation. So in that situation, you're likely going to have distributions in excess of basis. This is the most common reason that we see this happen. You have a lot of loans, but you're still taking draws of some of that loan money potentially, and that's what creates this issue. The other times we see this happen is just simply tracking errors. Remember, I talked about how basis is something that goes year to year to year. It's a rolling calculation. And so sometimes if you switch accountants, if you're not paying attention, if you're not tracking these different items, you could have a different starting basis from prior year that was wrong, and now you're creating an error here. And so that's where you can have some unintended consequences where maybe you didn't actually take distributions in excess of basis, but due to a tracking error, you did. So that's why we want to make sure, and we're going to talk about planning opportunities next, we want to make sure that we treat this correctly. All right, so let's talk about some planning opportunities around basis. First off, we want to keep a consistent record of our basis. Keep track of all income, any money you're putting into the business, any distributions. We want to have a track record. And if you think your accountant is doing it for you, they might, but let's also keep your own. So again, how do we calculate basis? It's how much money did we put into the business to start it. We're tracking all the profits that we have in our business year after year after year, minus losses we have in our businesses year after year after year. We're adding back any additional money we maybe put into the business, and we're subtracting any distributions that we have. Now, if you have a partnership, we also get to factor in your share of liabilities. The next thing we want to do is adjust distributions. Keep your distributions within your basis. If you're tracking this on a regular basis, on a regular occurrence, you know what your basis is on a regular occurrence. So we want to keep distributions within that basis so that we're not taking distributions in excess of basis and now getting hit with a capital gain tax. We might convert distributions to loans. So instead of taking a distribution, maybe we issue a short-term shareholder or partner loan where the business is going to loan the money instead of, and that we have to pay back, and it has to be legit. We have to have paperwork. We have to have pay interest rates. We have to do all the important stuff. But maybe instead of taking it as a distribution, we take it as a loan. Now this can be, we have to be very careful with this piece because the IRS could look at this as a bona fide distribution if we don't properly set this up. So again, we have to have loan paperwork, we have to be making payments, we have to be charging a reasonable interest rate and all those different things if we go down this route. But sometimes it can be an easy opportunity if you're just in a weird year where you just need that kind of short-term loan to help get past that. So again, that's the opportunity. Instead of taking a distribution that would cause you to be in excess of your basis, maybe we take a shareholder loan and that provides that opportunity. We can also increase basis through contributions. So we can contribute capital before taking distributions. Now, if you need the money, this probably doesn't make sense, but some opportunities, there might be opportunities here. And then also for S corporation owners, you might want to consider a salary versus a distribution for tax efficiency. Now, we would never say take a salary more than what's reasonable and necessary because obviously that's the benefit behind an S corporation. But sometimes there might be some planning there, especially if we're just looking year to year. There might be some overlap in one year to the other where this might make sense in an opportunity. So let's look at kind of an overall look at this. What factors into basis? Does debt factor into basis? So ask your question. If I have liabilities, if I have loans, does that impact my basis? Well, in a partnership, it would increase your business, or your basis. Debt would increase your basis in a partnership. With an S corporation, does not have any impact on your stock basis. What about distributions? Distributions in a partnership and an S corporation reduce your basis. What about income? Income, profit from your business. Profit from your business increases basis in a partnership and an S corporation. What about losses? Losses from your businesses. Losses decrease your basis in both a partnership and an S corporation. Now, what happens if you take a distribution in excess of your basis in your partnership or an S corporation? Either one, you're going to get hit with capital gain tax on whatever amount of that distribution is over and above your basis. So that's the key thing that we talk about. Again, the biggest difference between a partnership and an S corporation is debt. Debt increases basis in a partnership, but with an S corporation, it has no effect. And that's why we see a lot of people run down this trap. Whenever we see people run down this trap, they're more than likely in an S corporation. They have some type of liability or loan outstanding that's causing this impact. If you don't have liabilities or loan, but your accountant's telling you that you have distributions in excess of basis, I would say there's more than likely not a tracking error, something from year to year tracking that you want to look into, and make sure you look into that before actually filing that tax return. So here's the bottom line. If you're not tracking your basis, you're gambling with your tax bill. And the IRS, they don't care if it was an accident. What they care about is what's on paper. Don't be the business owner surprised by a tax bill you didn't see coming. Instead, be the one who's planning ahead. Keep clean books and make sure you look at every distribution the smart way. If this opened your eyes, don't forget to subscribe. Hit that like button and share it with a business owner and save them this painful surprise too. And if you want help from our team of tax pros navigating this, along with many other different tax strategies, visit taxelm.com. That's TAXELM.com, or click the link in the description for a free discovery call. We're helping people like you legally lower your tax bill every single day. Thanks for listening, and I'll see you on the next one.